Hello, this is Steve with the Free Bullion Investment Guide. Today is March 23rd, and I'm doing a review and outlook on the price of gold. This is gold's 4-hour chart. And in review of last week's video, I had shown you this rising expanding wedge in gold's price chart, as well as the head and shoulders pattern, which are both negative patterns in the price of gold. And I showed you this positive pattern, which is a falling expanding wedge. Now, in review of last week's video, I had told you in my outlook, I told you that the price of gold was expected to move sideways and down. And what I was basically doing was looking at the fundamentals, the technical analysis, and not looking at the fundamentals. Fundamentals always trumps technical analysis. And I was just blinded to the technical analysis and seeing the double negative and not seeing the positive in the fact that the Federal Reserve was going to leave rates unchanged and likely not going to change them anytime soon. And that's really what the market was seeing. They moved the price of gold higher. It consolidated, and then on Wednesday, at the time of the meeting and the announcement from the Federal Reserve, the price of gold shot up, testing the 1320 level. And then on Thursday, it came back down there was a report that some leading indicators were better than expected, and that helped the price of gold to fall. But then on Friday, we heard that the European PMI was worse than expected, and also that the yield curve was starting to invert in some areas. So that also brought more buying into gold. Now, I did want to show you this chart real quick. This is from Stock Charts. This is their inverted. It's their yield curve chart. This is the blue line is the S&P 500, and basically you can animate this chart, or you can simply click and grab this red line, and you can move it to see other times of how the yield curve moved in relation to the S&P 500, and it's fun to see how the yield curve, this is what the market does not want. They don't want the 3-month to be higher than the 30-year. That's a bad sign. And clearly the market did not like that, and so it sells off. And you can see that also more so back here, like in late 2000. We had inverted yield curve after inverted yield curve, and it just tumbled on down. And really, that's what starts to spook the market when they see that. This is yesterday's yield curve. So that also brought buying into the price of gold. Now, I will have links to all of these links, yield curve, so on, in the description section below. So I'm not sure if I stated this, but I had basically said that the price of gold was going to move sideways and then move down, and that clearly didn't happen. So we can remove the head and shoulders that got denied last week, and excuse the pop-up there, and we'll just push that to the side a little bit. Now, the falling expanding wedge was confirmed early last week, and we can remove that one here. And the rising expanding wedge, the large negative pattern here, it was tested, and the price of gold did fall below it, but it did not close below it. So if it doesn't close below it, then in my personal point of view, I don't think it should be a confirmed pattern. But it can be expanded to that low. So that's what I am going to do for the rising expanding wedge. Now, for the falling expanding wedge, I see a new one. We got a upper trend line here and a lower trend line here. And there's the new falling expanding wedge, which is a positive inside of a negative. Now, as far as the outlook of gold goes, I got the we will have a GDP revision. Now, the market expects 2.2% revision from last week's reported 2.6%. If 2.2% is what the GDP is revised to, then we should see the price of gold move higher. Time will tell what will happen, but whether that number is higher or lower will depend on how gold will move. If it is higher than the 2.6%, which is doubtful, we will see gold move down. But if it is lower than the 2.6% GDP rate that was reported last week, then we will likely see the price of gold move higher, because it will show a slowing in the economy and further reason for the Federal Reserve not to raise rates. We may see it test the 1320 level. It's doubtful that we'll see it test the next resistance level of 1330, but time will tell. We'll see. And we'll also have to pay attention to the yield curve. If that inverts more, that will also be another negative for the economy and a positive for gold. So in the outlook for gold, those are two indicators that we will want to pay attention to: the GDP report, the revised GDP report, and pay some close attention to the yield curve. So we have a negative, the rising expanding wedge, and looming over the falling expanding wedge, which is inside of it. And so again, I'm more so expecting the falling expanding wedge to be confirmed next week, more so than the rising expanding wedge, but we'll have to see. So I thank you for your time. Have a great week. Take care, and God bless.